Good afternoon and welcome to today's webinar, 2019 Outlook, The Digital Divide with Bernhard Koepp, CEO and Portfolio Manager at CJ Lawrence. Today's date is January 17, 2019. All attendees are in listen-only mode. Participants can use either their telephone or computer to hear the audio of today's broadcast. We also want to remind our audience that today's webinar is educational in nature. If you have any specific questions about today's topic, please email Bernhard at bkoepp@CJ Lawrence or call him at 212-888-6342. Now, let's begin. Bernhard has been advising private and institutional clients for more than 25 years through a variety of investment cycles. Bernhard applies his extensive knowledge of global markets and bottom-up security selection to construct tailor-made portfolios for the discerning investor. Prior to spearheading the relaunch of CJ Lawrence, Bernhard joined the ISI Inc. team in 1999, together led by Jim Maltz in order to launch ISI's Inc.'s account management initiative. Bernhard began his career in 1989 at Deutsche Bank in London, its structured corporate finance division. In conjunction with Jim Maltz, he launched and managed Deutsche Bank's top 50 U.S. fund and Deutsche Bank's Bulldog portfolios. In addition to managing individual accounts for high net worth individuals, Bernhard directs CJ Lawrence's thematic investment offerings, including the American Renaissance, European Select, and Bulldog portfolios, which I know he's going to speak about today. Bernhard received his MA in International Relations and Economics from Johns Hopkins University and his BA in International Studies from George Mason University. Bernhard is also the president and trustee of the Opera Foundation, a New York-based nonprofit involved in the arts. With that, welcome, Bernhard.
Thank you, Tina. So happy New Year. So it's already been a very interesting start for the year. So obviously the fourth quarter, we saw a lot of activity in markets. There was a lot of consternation about all sorts of things, but I think this actually sets up a very good start for the year. So I'm going to go through what we see are the opportunities for 2019 and some which really build on some of the themes that we've highlighted in the past. So if you follow my slides, page 2, just a quick recap of what our themes were for the past couple of years. 2017, if you recall, that was the perfect year. I mean, it was zero volatility. You had markets going up every single month. You had easy money. You had deregulation, obviously, after the presidential election here. You had fiscal stimulus coming in. It just was the absolute perfect year. Pretty much everybody, you could throw darts and make money that year. So for most investors, 2017 was an incredible experience. Fast forward to 2018, last year, everything went very smoothly until October, and then things started normalizing. So our theme for 2018 when we started the year was prepare for normal. The guiding paradigm after the big crisis we had in 2008, the credit crisis, was that we should be operating in an environment which was called new normal. Well, guess what? Normal started in 2018 as we expected, and that was really because the Fed started raising rates pretty aggressively. So we reinstated a real interest rate, negative rates, interest rates started turning positive. We've reinstated the notion of a risk premium. So, if rates are negative or zero, it's very hard to actually calculate risk and actually talk about asset classes based on risk premiums. Volatility returned with a vengeance in October. It took the whole year for that to happen, but when it happened, it hit like a brick. So the focus was on business cycles. So you saw a lot of economists and strategists saying, where are we in the business cycle? You had a lot of talk about, are we going into a recession or not? The synchronized upswings that we saw in the previous years off of all the stimulus, we started seeing decoupling of global economies. So You also saw divergence of currencies. These are all very normal sort of things that we've seen in markets in previous cycles. I mean, 10, 20 years ago, this was quite normal. The last thing here is with rising rates, deficit spending and rising rates, you have a crowding out effect. So you saw when oil prices hit rock bottom in the fourth quarter, you saw a return of this worry about credit. Is it possible for low credit companies to actually borrow money and so forth? So the people who won last year, and that was also our prediction for 2018, were people who were a little bit more active. So we would also argue it was really a return to active management. So 2019, where are we now? So economies are clearly slowing. There's no one disagrees that there is a slowdown in economic activity. We are forecasting also to about 2% GDP growth this year in the U.S. That's down from between 3 and 4% in 2018. So that's quite a slowdown. So we'll see that in earnings per share coming down. So my colleague Terry Gardner will go into much more detail on those things in his webinar, which he's also recording today. So policy uncertainties. Well, we're in the middle of the longest government shutdown ever. Policies matter. So, one of the things that kind of set off the volatility in the fourth quarter was when the handshake between our president and the Chinese premier did not translate into what the market was hoping was a resolution of the trade war, the trade dispute that's going on right now. Obviously trade tariffs slow growth, so we're seeing that in real terms now in China as well. You saw that with the surprise warning out of Apple on slowing iPhone sales in China, but you also saw it in a pretty dramatic sense out of a company called FedEx. FedEx obviously ships goods and packages all over the world, and it was interesting. They basically took out the entire gain in earnings that they thought that was going to occur in Europe, and obviously Europe is very much the growth in Europe is very much driven by trade. They took out all the profit that they thought they were going to get out of Europe in one full sweep. So that really showed that macro conditions are really deteriorating. So our theme going into 2019 is fade the macro trend, and that's a bit of a contrarian view. Most people are saying, well, in the absence of a recession, I mean, we're also not calling for a recession this year, you should shift into late cyclical type exposure. We don't think that's a prudent thing to do because the window of opportunity is way too short. The late cycle is compressed, and we have too many distortions on the policy front that have made that trade really hard to do. So we're focusing on what we think are very exciting opportunities, and that's really the title of this presentation, The Digital Divide. You're going to have the haves and have-nots in the digital world, and that's really the very large companies that are adopting digital practices to really drive their profits and growth. And we think that's really exciting these days. So one more slide just on how the market sets up, and that's page 3. If you look at statistics, and we got this from our friends at Evercore ISI, and that's Ed Hyman, who we worked with and for 16 years, he put this great statistic together. Corrections, if you look at the corrections, the 6 previous corrections in the market, and what in the absence of a recession in a growth environment, in a GDP growth environment, typically 6 months after that, you get a pretty nice return in the market. So as of yesterday, the market's been up about 6% so far. So we feel very comfortable buying companies and stocks at these levels. So let's get the show going here. So in terms of growth opportunities, we're living, and this is in the next page now, page 4. There are amazing growth opportunities in this digital era, and the more you read about this, and the mainstream is picking up on this, and it's really driven by machine learning, cloud computing, all these good things that you see every day on television now, where people are talking about these things. So the McKinsey study that came out in September really set the backdrop for this, which is until 2030, we expect a 13 trillion boost to GDP, global GDP, or 1.2% every year until 2030. This is an amazing turbocharging of growth around the world. I mean, everybody's doom and gloom about global slowdown. Well, guess what? There are technological factors now that are actually may offset that kind of slowdowns, and these are the things we're focusing on today. So if you look at what what the McKinsey study showed was that the revenue growth gain to the companies they studied, and it was hundreds of companies that they included in the study, will boost revenues between 1% and 9%. That's a lot. I mean, in a 3 to 4% global GDP growth environment, and we used to be sort of comfortable with more 4 to 5% GDP growth environments globally, a 1 to 9% boost in revenues is a huge number. So the final point to this is divergence. And this is where you have this idea of the digital divide. I mean, you're going to have companies and countries that are going to be major beneficiaries of this. And the companies and countries that are going to be beneficiaries are not necessarily emerging market economies. And that's sort of the favorite for asset allocators these days. Everybody wants you to invest in emerging market economies. We don't agree that that is the case, because the technology drivers that we're talking about are being implemented by the wealthy countries and also the big companies. So that's also a bit of a contrarian view, but we're quite comfortable making that forecast. So if we look at the secular growth drivers, so I said before, fade the macro trade. So we don't want to talk about macro much, and I'm purposely not including a lot of slides here on macro conditions, but let's focus on secular growth drivers. So on page 5, I'm showing you basically 5 big segments that are the secular growth drivers for the next decade. And that's really the digital transformation, and that's all about artificial intelligence, cloud computing. Then we have blockchain technology, we have mobile payments, which is, and that's going to be benefited massively by the 5G rollout. And I'll talk more about that. Then you have mobility and sensors and chips. This will affect everything from, mobile payments to autonomous vehicles and everything we know about transportation. And finally, which I think is the most exciting area for growth for our economy and the globe, is this convergence of data science and biotech. So let's look at those things a little bit more closely. So digital transformation on the next slide. So you know about these things. You live these things every day. So you have cloud computing. I mean, that's really the big players there are Microsoft, Google Cloud, AWS, which is obviously a part of Amazon. These companies, I mean, there's a lot of talk about FANG stocks and that being yesterday's stories. Well, guess what? Cloud computing is just at the beginning. I mean, the bulk of the economy is still running on servers that are actually sitting on people's companies. So there's a long way to go domestically as well as internationally in cloud computing. It's not only our domestic company, but I mean Alibaba, which is a company, a stock we actually like, and a company we like in China. Alibaba Cloud is also one of the fastest growing cloud providers. So if we look at around the different sectors, healthcare, Optum, which is a division of United Healthcare, they're using machine learning like crazy to actually analyze how they price premiums for healthcare, how they track diseases and so forth. Amazon, I mean, everybody knows that Amazon will track you when you use their services, or you're an Amazon Prime member. They basically know what you're going to buy, and it's really fascinating how that works. Companies even that are more bricks and mortar, like Ulta and Home Depot, are also using machine learning like crazy. Ulta made 2 very interesting acquisitions actually in artificial intelligence to basically help them with their customer interface. You will see Ulta, which is obviously a provider of beauty products to basically to women, they will be implementing and rolling out very interesting products, both on the physical side in terms of smart mirrors, to actual in their website, where they will know exactly what the beauty customer wants and predict that even before they want that. Then on the interface side, if you look on the left of this slide, you'll see companies like Adobe. I mean, Adobe, if you think about AI and Adobe are like one and the same thing. Every website today basically uses a front end that's somehow created by Adobe. And the analytics that all these websites use are created by the software that is in Adobe. So you can't, if you want to do machine learning, you got to use Adobe software. And the same kind of goes on the software side with Autodesk. That's for the contractors and architects. Very similar concept. Both of them actually sell their services through the cloud. Palo Alto is a new entrant, is a newer company or a smaller company for us. They are on the cybersecurity side. Obviously, with all these activities going on in the cloud like that, cybersecurity is a big topic. So let's move on to blockchain. It was very interesting just the other day, or yesterday actually, Bank of America had its earnings out. Everybody was blown away why Bank of America had such massive profits. Well, guess what? This was because of digital. So everybody's going, wow, how can this sleepy old bank, Bank of America, have a digital program? Well, guess what? Bank of America and JP Morgan are actually the two companies that are shaping the blockchain standard within financial services. So nobody talks about that. They're big companies, but they're driving profits and efficiencies through this distributed ledger system called blockchain, which will really revolutionize the financial services sector. The other three players that we really like there are Broadridge, S&P Global, and SS&C. All three of these are using blockchain technologies and investing heavily in them because they see, I mean, if you think about it in a nutshell, all three of these companies deal with a lot of data. If you're dealing with millions and millions of data points, the traditional database, Oracle type installed database platform is very inefficient and actually expensive. If you can adopt blockchain distributed ledger technologies, you're going to drive efficiency and your costs are going to decline. So the next slide is mobile payments and 5G rollout. So you've seen a lot of controversy, obviously, between China and the U.S. on who's building 5G. This is very exciting. I mean, 5G is going to basically make it any region that has 5G, you're not going to need Wi-Fi anymore. So if you have your iPhone or whatever smartphone you use, you won't be running around trying to find a good connection anymore. When you're within a 5G network, it's going to be 10 times faster than what you have had before. So there won't be any lag of downloads or anything that has, that you're getting from directly streaming from the web. So think of that, what capabilities that opens up for all sorts of businesses, whether it's payment systems or streaming content. There's no delay and no additional cost to use your mobile device within a 5G rollout. So we're studying this quite closely. American Tower is a play on that. Obviously, with increased use of mobile, if you think of the towers for cell phones, the antennas and all the things that make that work are going to be upgraded and more important, and there's going to be a lot more volume driven through these towers. So we think that's a great business going forward. On the payment side, MasterCard, Visa, I mean, we forget that Apple is also in that, and actually Starbucks through Square are also involved in payment platforms. And of course, Alipay, which is Alibaba, is the biggest payment platform internationally. Then finally, next slide. Again, I think this is the most exciting part of growth that we're finding in the next decade. And it's not only exciting because I think these companies are going to make a lot of money, but I think we have a real shot here in the next 2-3 years of solving some of the big diseases, whether it's cancer. So certainly oncology is the biggest area of focus for healthcare these days, with this intersection of biology and data science. So we are very excited about these companies we own here. Of course, the cloud guys are involved here. So you have Google Cloud that is partnering with some of these big biopharma type companies. You know, Regeneron has a pipeline that's in the immunotherapy side that's very exciting to us. And that's driven by, you know, the machines that Illumina sells. And these are genomics or DNA testing machines. And if you look at the little table that I put in there, I mean, only 5-6 years ago, it cost about $20 million just to analyze and sequence one genome. I mean, we're down to $100 per genome today. So, you know, big labs, whether you're at Stanford or at Mount Sinai or wherever, they can run thousands of sequences today at very low cost, which is driving the science forward very quickly. So you have companies like Regeneron, or on the devices side, Abbott or Becton Dickinson or Thermo Fisher on the life sciences side, that are really massive beneficiaries of that, including Boston Scientific also on that side. So if you look at page 10, this is the circle of trust of growth that we have. Basically, this matches up all of the different secular growth drivers that we are excited about with actual stocks. Again, this is a representation, and our valuations do matter to us. So we don't just buy stocks all purely based on thematic, but we do have a value discipline or a growth at a reasonable price discipline that we apply to each one of these stocks. But this is really the universe of stocks that you would probably see in your portfolio for the next couple of years. So if you look at page 11, Bulldogs, Tina mentioned Bulldogs. We've been quite well known for the last couple of decades for investing in what we call Bulldogs. Jamie Dimon yesterday at the New York Economics Club had a very nice quote when he was asked about why he missed in quotes his earnings by a couple of pennies. He said, "There's way too much short-termism. What's really important to me is market share," and this is the true trait of a Bulldog. And that's really a management team that's focused on taking market share in growing sectors. So JP Morgan is a Bulldog. If you look at the market share tables in Europe right now, the U.S. banks, and especially JP Morgan, are really killing European banks in investment banking and so forth, and lending abroad, because a lot of the banks in Europe and so forth have not recovered yet from the financial crisis. So our banks are taking market share. That's exactly the kind of company we want to invest in. So Bulldogs are all about unit growth. They're about dropping unit cost, and they're all about competitive duration. We want to invest in a company that has a competitive edge for a long, for many, many years. We don't want a short-term trade. Basically, a Bulldog is a company you would not want to compete with. That's really the main part of this. So page 12, that's just showing you a little of history. We believed in the so-called Bulldog Strategy for many, many years, and it grew out of this great research tradition at C.J. Lawrence already back in the 1980s. When C.J. Lawrence and our mentor Jim Moltz wrote about the new Nifty 50 and about all these companies that are driving unit cost or unit growth and driving market share, and that there were opportunities there. When we were at C.J. Lawrence, a part of Deutsche Bank, it was the same story. And then when we joined ISI in the early 2000s, we kept to our strategy, and today we're doing the same thing, and it's paid off for our clients over the years. So if you look at page 13, just to sum things up, give us a call. We're very excited about what we're doing. We're finding great investment ideas. We have publications that you can get. So our most recent portfolio strategy piece, which highlights the digital opportunity for these Bulldog companies that we talked about, That came out in October of last year, and then of course we have our weekly publication that Terry Gardner puts out, which you can also subscribe to. And I'll just end with the final slide. Give us a call. Our investment advisory team is very experienced. Terry Gardner, David Gallagher, and myself, we've been at it for at least almost three decades, and we would love to help you out with your portfolios. So I'll turn it back to you, Tina. Thank you very much.
Great. Thank you, Bernhard. That was well said. And if you have any questions, again, reach out to Bernhard directly and members of his team. We want to thank everyone for their time and wish everyone a happy and healthy new year. Thank you very much.